Hello, welcome everyone. April the 9th. So we're already April. Seems like yesterday that it was the beginning of 2024 actually, for me at least. So today we're gonna go through the essentials. Maybe I don't know, many of you might be experienced traders, so I guess you are well familiar with these terms. So I could state that this webinar is for newbies mainly, because we're gonna go through the essentials. Margin leverage swaps, what they are, how it affects your risk management, how you can calculate them, and etc. So it's mainly for beginners. Okay, so I need to go through the disclaimer warning as usual. Please, I would really appreciate the feedback regarding the audio. Let me know whether you can hear me loud and clear. This webinar is being recorded, so you're gonna receive, as soon as we're done, you're gonna receive a recording in your inbox. If you cannot find a recording in your inbox, that means that it might be in the spam folder. And if you still can't find the recording, please send us an email as soon as possible. So this material provides general market communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, take into account your investment objectives and level of experience before trading. And if necessary, seek independent advice. You can find the full risk disclosure in our website, guys. Feel free to visit the website www.hfm.com. Our email address, okay, as usual, webinars@hfm.com. Feel free to ask anything you want. Really appreciate the feedback regarding the audio. I can see that it's capturing sound, but just to make sure that everyone can hear me loud and clear. Now, this is me. Since 2016 in the company. My background is numerical, basically mathematics and physics, actuarial sciences, and after studies, I've been in the forex industry since then, since the end of my studies in UK. Here to help with anything you need, trying always to be on top of your request. I really appreciate the feedback regarding the analysis team as well. Feel free to let us know how we can help further. Margin, leverage, and swaps. Trading essentials decoded. This is what we're gonna go through today, as I already mentioned. Just to clarify, first of all, that this is absolutely an essential for everyone. Without having the knowledge and the understanding of what these things are, you're gonna fail. I know that this sounds a bit hard, and yeah, but if you don't understand or you don't know what leverage is, what margin is, what swap is, eventually you're gonna fail in your trading. You need to make sure that you understand the basics. There is plenty of free material out there. We offer plenty of free material as well. Make sure that if you want to succeed as a trader, as an investor, make sure that you comprehend fully these three terms. Can you do a video, please, so we can follow with ease? Kelly, you mean recorded videos, short videos regarding margin, leverage, and swaps? Is it what you mean? Instead of a webinar? Okay, there's no reply yet. Okay, so do you have a feedback from Kelly? I will proceed. Let's start with the term leverage. Okay, leverage, guys, I mean live video. This is a live one. I mean, the only, you mean like placing live positions. Okay, that would be a good idea. If this is what you mean, I will try to have it in mind. Let me put a note and to double check whether we are allowed to do something like that. But it's a good idea. It's a good idea. So let's start with the leverage. What leverage means? Leverage, it's like, I will not say the definition of CFD trading, the definition of contract of difference, but leverage is essential, is key feature for CFD trading, for contract of difference trading, because in simplicity, let's say, it helps you, it enables you to open a position by paying a fraction of the value, of the full value of that particular asset. Okay, so basically, leverage is a feature in trading, okay, in CFD trading, that enables you to open a position worth much more than the actual money that you have deposited. And I have examples over here. Think about, let's assume that you want to buy a house, right? So the house costs $100,000. Okay, so you have only the 20% in front, so you have to take a mortgage for the rest of the 80%, right? To take a loan basically from the bank, mortgage. So that means, okay, that you have a leverage 1 to 5. So you have only the 20% deposit out of the $100,000 that the house costs. So 1 to 5. You have, with this way, you have leveraged your 20K, your 20,000, to buy the house which worth 100,000. So you have 5 times the purchasing power of your initial deposit. So if we say that, for example, there is a leverage of 1 to 50, okay, that means that, again, if you have cash deposit, if you have your own money, 20,000 deposit, then this allow you to buy something for $1 million if the leverage is 1 to 50. So that's a very, very simple example. A very, very simple example. Yes, okay, Kelly, slowly. Let's see one by one, okay? So this is the main concept of leverage. So enables you in the Forex industry, it enables you to open a position. So let's try and okay. So let's assume, okay, this is gold, just to delete a bit. I cannot open positions because I don't have an, if I'm not mistaken, I don't have a demo deposit over here in this one. But in terms of trading, if you want, let's say, to open a trading gold, okay, and you have just, let's say, $100, okay, and you want let's say to open a position that it will give you back. Basically, actually, let's take it by, okay, here in gold, okay, gold right now worth 2,353, right? In order for you to open a position, right, without leverage, if there wasn't any leverage, then you for buying a gold, you had to have 2,353, the exact worth of the gold. But with leverage, you can deposit less and actually open a position. So you may open a trade on gold which might worth 2,353 with a deposit of, let's say, 200. Okay, so because the broker, in this case HFM, will put up the rest amount. So okay, 200, let's make it round, 2,000. Let's say that gold worth 2,000, you have 200. So the broker will put up the rest of the $1,800. With this way, it will enable you to open a position which is 10 times more than your initial outlay. Right? Oh, good so far? So this is what this trading is about. As simple as the example of a house that I mentioned, okay? But it's not only but interpreted, let's say, in the Forex industry. So if you want to if for example, you might be able to multiply your position size by 5, 10, 20, or even 30 times the amount of your initial outlay. This is what the leverage is for. So when trading, remember that you are guessing, you are speculating on the price movements, right? So rather than owning the asset, gold or a stock or a currency, etc., instead of owning this asset outright in the hope of making a profit, when you trade with leverage products such as the CFDs, it means that most of the capital is put up by your broker, with you putting down a deposit worth a fraction, a part of the trade size in order for you to be able to open a large position. Another example that I could say out loud, trading on stocks with leverage, for example. Again, opening a position with a broker and loaning most of the position's value amount, depending on the leverage ratio from that broker. There won't be a charge for how much leverage you use, right? Whether it's 5% more or 20% more. But we're gonna see later on the risk regarding this. because it gives you the benefit of opening position that they worth X times of your deposit, but it also is a double sword, and I'm going to explain later on why. But let's comprehend what CFD in trading is. So let's take another example. Let's assume that you want to trade 1,000 shares in a company A. Let's call it Tesla, in Tesla, okay? Tesla now worth $25, as I stated here, okay? So you invest on it. So you buy, let's say you buy 100 CFDs on that particular company, on the 100 shares of that particular company. So it was each stock price right now, sorry, it was $25. You bought 100 shares of that company. So that means that the total size of your position will be 25 multiplied by 100 shares. So 2,500, right? Okay. So far, so good. Let me know, interrupt me if you need something to be explained further. So remember that we are referring in leverage. That leverage works in CFDs, in leverage products, in contract of difference. So since leverage works in CFDs, because basically you don't own the shares, you trade them, you enter a position only speculating their price movement. So you didn't actually bought or sell, if there was a different scenario, that asset. You were only speculating on price movement. What that means, it means you don't have to pay the full value of the chosen asset. So you don't have to pay the 2,500 that I put over here. So for that particular example, and we said that you want to open 100 to buy 100 CFDs of that particular company. The deposit required to open the trade, okay, is 30% of that of the total size of the position. So that means that you will need a deposit of $750 in order to execute your trade, which worth the value of this trade is $2,500. Is that clear? Hopefully it is. Okay, so yeah, the margin, the deposit, actually, the amount of money that required is 30% for that particular stock. So that means by using CFDs, you only have to deposit $750 to execute your trade. Okay. Another example. Now, just to see the difference when you have leverage or you don't have leverage. When you don't have leverage, right? Sorry. When you don't have leverage, if you wish to buy 100 shares, then you need to pay the full amount of it, the full value of that trade. So 2,500 is like the example that I gave you earlier regarding the gold. Now, Okay, before we come to the leverage ratio, one more verbal at least example, okay, for you guys, just to help you further comprehend this. Let's assume that we have, where is my Nasdaq of S&P 500? Where's my Nasdaq? Okay, I cannot find my S&P 500. Let's stick on the, here is, let's say, is the Nasdaq, okay? Let's assume that you want to trade 10, you want to trade 10 Nasdaq CFDs. And right now the price of, okay, actually this is a huge number. Let's, where's Dow is 39. Let me simplify a bit the example because these numbers are huge. So let me find something. Okay, let's stick to the S&P 500. So let's assume that you want to trade 10 USA 500 CFDs. Right now the S&P 500 is worth 5,200. I would make it 5,000 just for the sake of being a round number. Let's say that it was 5,000. You want to trade 10 CFDs. So that means that, sorry, that means that 10 times the 5,000 is $50,000. But you won't need that much in your account to execute your trades because, as I said earlier, CFDs have leverage. They are leverage products. So you will just need to put down your margin. So, let's stick here. So you need just to put down your your margin, not the full value of the position. So your profit or loss, though, your expected profit or loss, though, will still be based on the full $50,000. So you will make $10 for every point that the S&P 500 moves up, and lose $10 for every point that it moves down. And I'm going to show you an example for that, which is later on. We're going to see that this is a double sword. In the meantime, let's make sure that you understand what leverage is and what leverage ratio is, because I mentioned several times that the amount of the money deposited and the exposure in the market. So like the example in the house, 20K, you had 20K in front, you borrowed 80K from the bank, the house worth $100,000, so that means a ratio 1 to 5. So that's called leverage ratio. So basically, leverage ratio is the measurement of your trade's total exposure compared to the deposit requirements, to the margin requirements. This is what margin is, the deposit requirements. So your leverage ratio will vary. That depends on the market you are trading. Whether you're trading a currency, whether you're trading a stock, whether you are trading a commodity, and also with which broker you are trading with, and also the size of the position that you decided to open. So if you open a huge position, obviously the deposit requirement will be big. So let's use this example. So this is if I don't have a leverage for unleveraged trading. So as much if the asset worth $1,000, I need to put a deposit of $1,000, and I will get a deposit exposure of $1,000. Okay, this is what I say. If you want to buy actual stocks, let's say, then you need to pay the full amount of what they worth. But if you have a leverage, so let's assume that you deposited 1,000. Okay, you deposited 1,000. So as a deposit requirement, as a margin, your investment, though your exposure in the market worth 20,000. So that means that you have 20 times more exposure than the amount of the money that you have deposited. So that gives a leverage ratio 1 to 20, because your exposure is 20 times more than your initial investment. The same stance if you chose an exposure 50 times more, so that means 1 to 50, 100 times more, and 1 to 100, 2 times more, 1 to 200, and so on and so forth. Bear in mind that often the more volatile or less liquid an underlying market is, the lower the leverage on offer in order to protect your position from a snap rapid price movement. On the other hand, so if it's a less liquid market, such as ETFs, or such as let me think about less liquid dollar ZAR, dollar one, and etc. If it's less liquid, that I said, the lower the leverage on offer is. On the other hand, if we have a market that is extremely liquid, such as Forex, so euro dollar, pound yen, which is the most volatile Forex pair, dollar yen, etc. These are extremely liquid markets. Then these markets tends to have particularly high leverage ratios. So, okay, this was a clear example on how the different degrees of leverage ratio affects your exposure, right? And what's the required deposit. But if you visit our website and find the table that we have for every asset, you're gonna see also the leverage provided, the excessive, the leverage is provided as well. So, okay, that's another example, just a more visualization, let's say, of the deposit and the exposure. If I have a leverage 1 to 100, if I have a leverage 1 to 50, then I need $2,000 to pay a deposit. You have to pay a deposit of $2,000, which is also called margin, and the exposure will be 50 times more. So that means that your position will worth $100,000. But there is a huge but, guys, in regarding to the leverage. Everything sounds very nice, promising, yes, with just a tiny deposit that can open a big position and have big profits and etc. But it's not as simple as that. Although you are only paying a small percentage of the full trader's value up front, your deposit or loss will be calculated on the full position size, not your margin amount. So it is indeed leverage, it is indeed a powerful benefit, but it will also increase your risk. Okay, so before you start trading, I want you to focus and spend time in your demo account understanding how the leverage might impact your potential trades. There are ways to manage this risk that the leverage can cause using stop losses and other techniques, and there are particular strategies as well. We're going to see them later on, but it's a double sword, and let's explain why. So this is when everything goes as it should and we end up with profit. Let's assume that you have decided to open that you have seen, let's say that you have seen that Tesla is rising, okay? Its stock price rallies because of the earnings, let's assume, okay? And you have seen that and you want to enter a trade, okay? And again, when you initially enter the trade and you bought 100, it's the same example, but now we're gonna see how you're gonna cash out if it was a position on your benefit or even it was against you. So you bought the 100 shares. I'm gonna use the same example as we said earlier. So you bought the 100 shares of Tesla. Back then it was $25. So you deposited $750. So now, however, the price has increased to $26. So you decide to close out your trade. It went up. I want to close my trade, right? So that would have made a return of 13.3%. Why? Because $26 is when you close your trade. You bought it initially 25, so 26 minus 25, okay? Multiply by by 1,000, okay? That gives us, sorry, 100 by multiplied by 100 shares. That gives us $100, right? But which is if we this is in case you didn't had any leverage. But if you had leverage, that will return 13.3% of your initial investment, okay? So with both, let's say, a traditional stockbroker and CFD trading, you will have a return of 26 minus 25 multiplied by 1,000. So that will give a return of 13.3% compared to a 4% return if you didn't have any deposit. Is this clear or not? Anyone? Remember that you only deposited $750 to open the CFD position. Clear, cool. Now, what happens if it was against you? Then the same amount of loss will be applied in your accounts, but it will be a loss. That's how leverage works. So it works the same way as with a profitable position. So suppose your trade was unsuccessful and you decided to close with a loss, with $100 loss. So in this scenario, the return on your CFD deposit will be a negative 13.3% because you've lost $100 when you deposited $750. So you will lose $100. While if you didn't have a leverage, the return on your stock trade will be minus 4%. So using leverage can magnify your profits, but it can magnify your losses as well. That's why it requires the risk management techniques. I'm gonna go through what that means and how you can protect, let's say, or limit the risk, protect yourself, or limit at least the risk in the forex industry, in trading in general. So let's check the pros and cons. So from the one hand, as we said, so just so far so good, guys. Do you want me to do more examples? I cannot open position, unfortunately. Let me double check. Actually can't, but over here I have done nothing. Oops. Okay, let me close it and do a proper example. Sorry. Close. Okay. Okay, apparently I have some money in. It's a demo account though, so it's fake money. Okay, it's just for the sake of practice. Let's DAX was interesting earlier. Where was DAX? Come on, Andrea. DAX. Where's my DAX? Come on. Ger. Okay, here it is. Oh, it's a demo account and shows. We just, okay, here we are. Won't like my heightened. Heightened. It's my heightened. Sorry for that, just for the sake of demonstration. I felt like blind. I cannot see I cannot find my heightened. It's not in the examples. Heightened, here it is. Perfect. Okay. So let's assume that I want to, first of all, I want to open a trade for DAX. though the DAX now worth 18,400 $400, right? But I don't have such amount of money, okay? So I don't want to open a position that it's that big. So what I can do, first of all, do you prefer, by the way, an example for that is a Forex example, or you're fine with any? No? Anyone? So let's assume, let me do the maths. 18,437. Let's assume that I want to risk, let's say, only $200. Okay, only $200. I don't wish to deposit more for that particular trade. I'm gonna open a short position as well. Will be a short position with an initial deposit $200. So let me do the maths. Let me just do the maths. Come on. Sorry guys, just a second to calculate anything needed. So now let's make it round. Let's assume that I want in order to I want to invest, to deposit only $184, okay, $184 in order to have an exposure of 100 times more. So that means that I have a margin ratio, a leverage ratio 1 to 100, right? 1 to 100. What else? Okay, I'm not gonna play stop loss right now and take profit right now. So for having 1 to 100, let me do the maths for God's sake. 1 to 100, it works. Did anyone any good example is okay. Sorry, I'm stuck right here. I'm stuck. So okay, I'm gonna keep the trade size at 10. Okay, trade size at 10. So leverage is, let me just 2,000. The leverage, as I said, I want it to be, leverage I want it to be 100, 1 to 100, multiply by the value of DAX, so 18,430. So let me just 100 Come on, Andrea, come on. Da, da, da. So the margin requirement, I don't know whether, and I haven't put I haven't placed actually a calculation, even though it's something that are a lot of calculators out there that you can use automatically for identifying your sorry, the how much money you will need per asset with particular ratio, leverage ratio, trade position, and etc. There are a lot of free calculators. There is, if you download AutoChart is, by the way, as well, you can find a free, let's say, a free come on, Andrea, a free calculator in order to identify the margin required based on the volume size that you want to have, on the deposit that you want to have, and etc. Actually, because it might be a bit tricky, it's 100. It's 100 over. I decided to have 100 leverage as well, multiplied by 18,000. So that requires actually a huge deposit. I need to deduct it even more. Let's make a simpler one. Shall we use currency pair instead? Let's use currency pair instead, actually. Yeah, much simpler than indices. So our account is on dollars, right? Right now, dollar yen worth 151.82. So I have an account with HFM. Okay, all good. A standard one. So one lot worth 100,000 units. I wish to have volume in loss as big as 10, which is a big, huge. Okay, so sorry. I want to buy it just randomly. Okay, I haven't done any analysis for that. So, okay, volume of 10 is huge. Let's set it to 5. Actually, okay, never mind. 10, just, I have a leverage 1 to 30 because unfortunately I'm in a EU account over here. So that requires if the leverage is 1 to 30 with 10 volume in lots, okay, that requires 33,333 dollars as a deposit, which is huge because I have placed a really high volume. I open a huge position. If I deduct it to one lot only, okay, that means that with a leverage 1 to 30, I need to deposit $3,000 for opening a position that is 30 times more than my deposit. Okay, that's a standard account. That means one lot is $1,000, so that's still huge. So if I open half position, 50, come on, Andrea, Yes, that will require, again, 1,666 required margin. I know that sounds crazy, but it's because I've used a leverage 1 to 30, okay? I have a low leverage. That's the only reason. So basically the calculation is convert your volume into units. So one standard lot is 100,000 units, right? Over, so divided by the leverage. So let's assume that you had a leverage 100, 1 to 100. Okay, multiply that amount, multiply by the amount that the asset worth, and that gives you the required margin, the required deposit. Okay, if for example we use euro dollar, a much simpler example, I want to open a short position. The exchange rate now right now is 108. What else? Let's open it. So yes, I have a standard lot. I'm gonna open one full lot, okay, just for the sake of simplicity. So that means, come on, Andrea, I'm gonna put higher leverage. So in this case, let me write down basically so you can see it. So that means that, so not easy, not easy, not easy to write. Okay, so let's assume that I have a leverage 1 to 100. I open one lot, okay, in euro dollar. So that means 100,000 units divided by 100 leverage that I use, multiplied by 1.08 something that is now the euro dollar worths. So that means 1, 2, 3, 1, 2, 3, that I need a deposit of $1,085 in order to open a position with exposure $100 more than it worth. Okay. Now let's move on. Let's move on. Is it clear? Okay. Let's move on and see the pros and cons of having leverage. So one thing is that it magnifies your profits, right? Because, for example, if this example that I gave earlier, rise, so sorry, it was a short position. So let's assume that it went on our favor, and we want to close the position because it moved indeed down. So if indeed, let's say, if indeed dollar, where's the, okay, if indeed dollar fell from 106 down to 1040, 108.40, okay, let's assume that. So it moved, let's say that we open a position at 108.60, it moved down to 108.40, okay. We set one lot size, so that means it moved by 20 pips lower, okay, by 20 by 20 pips lower. Our target was 108.40, so we want to take the profit right now. So that means come on, that we have, in order to calculate the stop loss, the profit, come on, let me do the maths, just quickly let me do the maths. Assuming that our account base is in dollars, okay? I'm not converting the amount into anything else. I assume that my account is on so that means that I'm gonna gain, I have invested $1,084, so I'm gonna the pip value formula multiply by the amount, so 108,040 multiplied by the 181,085, that means multiply by 0.020. So that means that I'm gonna gain another $400 more than my, so return of $400. That's very, very briefly round numbers, okay? So let's move on. Sorry, that took longer than I should. Let's move on and see the pros and cons. So the pros and cons, basically very, very simple. Indeed, it magnifies your our profit. So you only have to put down a fraction, as we said, of the value of your trade to receive the same profit, because the profits are calculated using the full value of your position. Okay, so the margin can multiply your return on successful trades. But on the flip side, losses will be magnified as well. So simply because the initial deposit is comparatively smaller than conventional trade. So it's easy to forget the amount of capital you are placing at risk. You won't be able to lose more, however, than the balance of your account. But you should always, always, always consider your trade in terms of its full value and downside potential. So you should in advance calculate basically both your profit or your potential loss in order to make sure that you are okay in case that something goes wrong and the market turns against you, that you are okay losing this amount, the X amount of money. Okay, that's called manage your risk in advance. Another benefit, let's say, is the fact that it's gearing opportunities. So using leverage can free up capital that you can be committed to other investments. So you can, it's the fact that it's a fraction of the value. So you can have like $1,000 deposited and you might want to risk only $100 for euro dollar, another $100 in DAX, another $100 in FTSE, and so on and so forth. So you have the ability to increase the amount of available for investment. Yeah, so a con though, there are some fees, there are funding charges. So when you use leverage, you are effectively being lent the money to open a position, right? So if you want to keep your position open, especially overnight, unfortunately, you will be charged a small fee to cover the cost of keeping the trade open. So there is a fee overnight. So, shorting the market. So using leverage products, remember that you're basically speculating the price, which is something that enables you to benefit from the markets even when they are falling, not only rising. So that's another benefit. Another benefit is the fact that you have a 24-hour dealing. So basically, though the trading hours vary from market to market, there are some certain markets such as Forex and some key indices such as DAX, FTSE, NXP 500, etc., that are available to trade around the clock. Now, the very last two risks and cons is the fact that you don't have any shareholder privilege because they are CFDs. You don't own the asset, okay? And also the margin calls. Basically, if the market comes against you, moves against you, if you open a long position but the asset started falling, so it's coming against you, your provider, your broker, will ask you to put additional funds if you want to keep your trade open. If you don't want you to keep your trade open and you prefer to close it in loss, then that's fine. But if you wish to keep it open on the belief that it will get back to the upside and it will eventually close positive, it will continue rally, let's say, then you're gonna have a margin call. So a margin call is an alert in order for you to either add a capital or exit your position to reduce your total exposure. So this is what is margin call. Basically, margin, remember the margin is the deposit, the initial deposit that allows you to open the trade. Margin is the deposit, leverage is the loan. So in Forex is the same. Forex works the same way. You deposit your initial margin as a sign of good faith. Your broker can then release the rest of the funds to allow you to trade. We have margin call, which is the most important term of all. Okay, basically, margin call is the alert, let's say, the notification that we will get if the market turns against us, and in order to ensure that we have the required funds to keep the trade open, you need to either deposit more money or to decide to close the position in loss. This is the situation where that is called margin call. Margin call is when basically the amount of money that you have placed in your account cannot cover anymore your loss. So if you want to keep your position open, you are required to add additional funds, okay, or to close the position in a loss. An example of something like that is, just to understand the margin call, guys. Okay, oops, come on. Let's assume that, let's take again the previous example. Remember that you bought 100 shares of this company. So you deposited only 750, even though it's worth 2,500. Now, if the company's stock price falls and your position lose $50, then automatically the equity in your account falls to 700. From 750, your position sits by $50. So that means that you will only have 700 equity in your account. That's not enough money to cover your margin requirements, your deposit requirements. So you're going to have a margin call. So if you wish to keep your position open, you need to add more. Anyway, your position right now is at the risk of being closed automatically or even liquidated. sorry. Yes, so this is the situation when we say that we have a margin call. So how do you calculate your required margin, or on any position, basically, either buying position or a selling position? So you will basically multiply, remember that, so basically, as we gave out this example, again, is multiply how many assets you want to buy by their value, considering the leverage that you need. Okay, 15% over here is the margin factor. So there is a margin factor of 15%. So that means that you need 5,100 pounds if you want to buy 5 FTSE CFD contracts, which worth 34,000 pounds. If the FTSE starts falling, you need to put as much money as needed in order to keep the equity at 5,100. Okay. So remember, okay, you're gonna get a margin call. Indeed, you will get a notification. When do you get a notification? If the position dropped beneath 50% of your deposit requirement, of your margin requirement. Okay, so for example, if your deposit was 700, if it falls down to 350 and less, then you will have your position will close automatically without you doing anything. You can do something before the 50%, not after the 50%. If you remain on a constant margin call, so if you're for 24 hours, your position is in a margin call situation, so it's below the required margin, then the position will get closed automatically. If you are on a margin call, but there is it's a period of increased volatility because, I don't know, it might be news, might be the NFP. So if there is an increased volatility, significant liquidity, volatility, sorry, you might see again your position closing automatically, because it will probably, because of the volatility, will actually fell below 50%. That's why. And last but not least, if you are on a margin call into the weekend, so you will probably, if you don't sort it out, okay, and if you are since your margin requirements have changed and you are close to the weekend, it's Friday morning or Friday evening that the markets will close, okay, because we're going to the weekend. So if the equity is below 100% of your margin requirement, your position will be at an increased risk, okay, an increased risk of being closed on Friday evening, okay. Either any of these four situations is when you're gonna get, your position will be closed automatically. Each there are several margin requirements. You need to check the website per asset, I mean. It's important, however, to remember that it is your responsibility to have enough funds on your account in order to fully cover the margin requirement of your open position, because if it falls, then it could close any time if any of these situations happen. Okay. Risks, last but not least, actually we have also swaps, but let's quickly see some risk management techniques that you can follow for limiting the risk from the margin calls. Sorry, from the leverage and margin calls as well, but leverage. Basically, it's the usual suspects. Have stop loss. Remember, stop loss. Attaching a stop to your position can restrict your losses if a price moves against you. So you know that during volatile times, volatile day, markets move quickly. So have a stop loss always, always, always. Okay. Markets move quickly, and certain conditions may result in your stop not being triggered at the price you've set. Okay, so keep an eye and restrict your losses. Guarantee stops, otherwise, similar to the standard stop levels, fixed stop levels that we put, right? Sorry, I ran out of steam a bit. Okay. So guarantee stops. What I mean by guarantee stop, to always to attach a fixed stop to your position, and it will always be closed out at exactly the price you specified. So you will only pay for your stop if it's triggered. If this happens on a guarantee stop. Limit orders, trailing stop losses. Don't forget the trailing stop losses. And guarantee orders. So what we mean by guarantee orders? Stop limit, buy stop, sell stop, and etc. Limit orders. There are orders that are executed automatically in a predetermined level that you have placed. So you can, with this way, set a limit entry order to open a position or a limit close in order to terminate an existing position. And don't forget that we have also a negative balance protection. So in the event of a negative balance, we will, as a broker, restore it to zero at no expenses to you. Not all our brokers offer a negative balance protection, okay? As HFM, we do offer negative balance correction, so your account will never go below zero, so you will not own us money in case something goes awfully wrong. Even if the market gaps, thanks to the negative balance protection, you will never go below zero. Yes, sell stop, buy limit, sell limit, negative balance protection, stop, stops, a visible running balance, whether you are up, you're down in total, you can find it in MT4 and MT5. And our HFM app as well, it's visible surplus or shortage balance. These are more examples. In this time I have dollar yen. An example when the with leverage, and an example without leverage, and with an example with leverage. Deposited $1,000, open a position of one full lot. Really, here it is, one full lot. it went down to 112, so that gave us $446, or otherwise 44% return. But if it was on the flip side, if it decreased by 50 pips higher, so against the position, against the short position, then that would have been our loss. Swap, last but not least. If position is closed, it means you lose your money. You mean if you got a march, you are in a margin call. Yes, you will lose the amount of money that you have risked. So if you have risked $100 and you are a margin call and you didn't deposit it, you will either, as soon as you have the margin call, close it. So with this way, you will lose part of your position. You will lose part of what you deposited. Or if you leave it to close automatically, that means that you will lose the amount that you deposited for that particular position, not of your whole account, William. Okay, so in the example of Nasdaq, of dollar yen, I have deposited 1,000. Okay, if I get a margin call when my margin fell at 800, okay, then you need to think about it. Shall I close it and lose only 200, or shall I leave it because I believe it will revert back higher again? It's your decision. If you decide not to either top up more money or to close the position, that means that if eventually the margin call continues until and the how we call it, the margin falls more than 50%. So if it falls to $400, okay, the margin, that means that it will be automatically closed and you will have lose $600. Or if it's a very, very volatile session, and you might even lose all the initial margin for that position, all the 1,000. That's why when you get a margin call, you need to decide, I'm gonna keep my position open and just add more money in order not to be stop out, or I'm gonna leave it as it is, or I'm gonna close it in order not to suffer more losses. No, would you recommend keeping the stop loss during the weekend? It happened to me that at opening market on Monday, the sudden volatility blew even beyond its level. It was a gap actually. Yeah, okay, wait a minute. So you mean to keep a position open, a position that is on a margin call or not? If a position is not in a margin call and you want to keep it open during the weekend, then this, what you described, might happen, yes. But if it's not in a margin call, it's okay keeping it over the weekend. Just have in mind that the charges will be triple than usual. The swaps charges will be triple than usual. So it depends on the position size, or whether you are in margin call or not. If you're moving to the weekend and you are in profit, but you want to keep it until the next week, you can close partially some profits, so you can move your stop loss higher in order to lock some profits, if and only if you are in a profit, just to make a stop loss tighter. Just just if and only if, and with the new open, it comes against you. So it happened to me that opening market on Monday, the sudden volatility blew even beyond its level. There was a gap. So you kick your stop loss by Monday, you mean, with a gap? Okay. So I assume you had this in mind when you decided to keep the trade open over the weekend. Because even if there wasn't a gap, okay, if there wasn't a sudden volatility, on Monday morning might started going against you either way. But yes, unfortunately, depending on the market, yes. Remember that some assets are more liquid than others, more volatile than others. So this is a risk that you are taking if you decide to keep the position open over the weekend, especially because over the weekend we have seen a repositioning in the market, especially if it's the end of the quarter, a new quarter comes with the Monday morning, or a new month comes on Monday morning. There's a lot of repositioning. That's what might happen if you have seen this sudden volatility and gap. What you could do as you move on into the weekend is to lock some profits, to be honest. I'm not gonna say to move your stop loss away, because this will mean that you will increase your risk as well. So lock some profits, or either close fully your position. This happens. We cannot be right all the time. Market cannot be on our side all the time. As long as you are in a profit at the end of each month, at the end of each week, right? Okay, last but not least, guys, because we're already an hour and a half, what we mean by swaps basically is the fees when we keep the position open overnight or over the weekend. Okay, this is it is an interest rate placed due to the fact that we keep position open from a day after day. I mean, overnight is something that it might be a fee that we might be charged, but it might be a fee also that we might gain. So it's not that you're gonna if the currency bought has a higher interest rate than the one sold, a swap will be credited to your account. So it's on your favor. That's why we have the swap strategies. But if the interest rate is lower for the bought currency, a swap will be charged. On this website, our website, I have put a link so you can find examples of the fees along with calculations on how you can calculate the swap fee, otherwise called rollover fee, rollover interest rate fee. You can find it with many terms, but it won't be always debited. It might be credited as well, exactly because of the reason that I just mentioned. Guys, we're already an hour and a half live. I'm gonna call it a day. Please check these examples that I put on for a short position in pound dollar, for a long position for Nasdaq. So position size, the counterparty fee, internal interest fee, pip value over currency rate. So this means that you're gonna be charged if you keep for a day your position open at 0.78. But in the case that the amount bought, the asset bought is higher than the asset sold, then will be credited. So you're gonna have a plus. Yeah. So that's pretty much it. There are a lot of swap trading strategies, by the way, from long-term traders, short-term traders, carry trade traders. So have a look, and anything you need, we are here to help. So I'm gonna call it a day. Thank you very much. You're gonna get the recording later on. Anything you need, I'm here to help. Don't hesitate to send me an email. Yeah, and I'm gonna try, Kelly, to try and I'm gonna need to ask actually whether I'm allowed to place an entry live for you to see. So yeah, thank you very much for that suggestion. Have a great day ahead and see you again tomorrow with another webinar from my colleague Michalis tomorrow. Visit our webinars page to see all the schedule of April. Tomorrow, Michalis will go through short-term entries and exits. Very, very, very useful. Thank you. Bye-bye.